Hello, everyone. Before your next Social Security payment arrives, take a close look at what is being deducted from it. For some retirees, one voluntary deduction may no longer be necessary. For others, a state program may be able to pay the entire $202.90 monthly Medicare Part B premium. A recently created federal deduction may reduce taxable income by as much as $6,000 for one eligible senior or $12,000 for a qualifying married couple. And if Medicare is charging you more because of an old high-income year, there may be a legitimate process for asking Social Security to reconsider that premium. But stop right there before canceling or refusing to pay anything. There is no universal 2026 law that erased 5 bills for every senior in America. These are 5 completely different forms of potential relief. One involves voluntary tax withholding. One is a federal tax deduction. One is a state-administered Medicare assistance program. One depends on state and local property tax law. And one is a request to reconsider an income-related Medicare surcharge. Each has separate qualifications, forms, and risks. In this video, I'll show you what is actually available, who may qualify, what document to examine, and the exact question to ask before making any changes. As of June 2026, here is what retirees and older taxpayers need to check. And while you're watching, tell us in the comments, are you already retired, retiring within the next 5 years, or still more than 5 years away? Never post your Social Security number, Medicare number, or exact private financial information. Let us begin with the money that may already be coming out of your Social Security payment. Number 1 is voluntary federal income tax withholding. Social Security beneficiaries can request that 7%, 10%, 12%, or 22% of their monthly payment be withheld for federal income taxes. You can also request that the withholding percentage be changed or that withholding be stopped. But this is the important distinction. Stopping withholding does not erase federal income tax that you may ultimately owe. Withholding is simply a way of paying estimated tax throughout the year instead of facing a larger bill when you file your return. Whether you should reduce or stop it depends on your complete financial situation, not only the size of your Social Security payment. To make an initial estimate, begin with 1/2 of your annual Social Security benefits. Then add your other income. That may include pension payments, wages, traditional IRA or 401k withdrawals, interest, dividends, capital gains, and tax-exempt interest. For a single filer, head of household, or qualifying surviving spouse, part of Social Security may become taxable when this combined amount exceeds $25,000. For a married couple filing jointly, the base amount is $32,000. Different and often less favorable rules apply to some married people who file separately. At higher combined income levels, up to 85% of Social Security benefits may be included in taxable income. That does not mean your benefits are taxed at an 85% tax rate. It means that up to 85% of the benefit may be included in the income on which your normal federal tax rate is calculated. Here's why 2 retirees receiving the same Social Security payment may need completely different withholding decisions. Imagine that Linda receives Social Security and only a small amount of bank interest. After completing the proper calculation, she may discover that none of her Social Security is taxable and that her existing withholding is unnecessarily high. Now imagine that James receives the same Social Security payment but also withdraws $30,000 from a traditional IRA. That IRA withdrawal may cause part of his Social Security to become taxable and may create a federal tax bill. The monthly Social Security payments are identical. The tax results are not. Before changing your withholding, review your latest tax return and estimate your income for the entire current year. Do not forget planned retirement account withdrawals, investment sales, pension income, wages, or a major one-time transaction later in the year. When you have made the calculation, Social Security currently allows beneficiaries to start, change, or stop voluntary withholding through a personal My Social Security account. You can also use Form W-4V or call Social Security. If you submit Form W-4V, it goes to Social Security, not to the IRS. Keep a copy of anything you submit and check a future payment to confirm that the requested change was processed. Number 2 is real, but it is widely misunderstood. It is the enhanced federal deduction for seniors. Under current law, eligible taxpayers age 65 and older may claim an additional deduction of up to $6,000. If both spouses qualify and file jointly, the maximum combined deduction is $12,000. This provision applies for tax years 2025 through 2028 unless Congress changes the law. It is separate from the older additional standard deduction amount already available based on age. Eligible taxpayers may claim the enhanced senior deduction whether they use the standard deduction or itemize their deductions. But there are several qualifications. The deduction begins to phase out when modified adjusted gross income exceeds $75,000 for most individual filers, or $150,000 for married couples filing jointly. A married person generally must file a joint return to claim it. Each eligible taxpayer claiming the deduction must have a valid Social Security number. The deduction is calculated on Schedule 1A. Now here is the misunderstanding that could create unrealistic expectations. A $6,000 deduction is not a $6,000 government check. It is not automatically a $6,000 refund, and it does not mean every qualifying senior will save exactly $6,000 in taxes. A deduction reduces the amount of income used to calculate federal tax. The actual reduction in your tax bill depends on your taxable income, tax bracket, phase-out calculation, other deductions, and the rest of your return. Someone receiving the full deduction may save only a portion of $6,000 in actual federal tax. Someone whose income falls within the phase-out range may receive less than the full deduction, and someone who already owes little or no federal income tax may receive limited practical benefit. The correct question to ask your tax preparer is not, "Am I receiving the $6,000 senior payment?" Instead, ask, "Did you review Schedule 1A and calculate the enhanced senior deduction separately from the existing additional standard deduction for age?" If both spouses qualify, ask the preparer to confirm that both eligible individuals were included. This is current law, but it is temporary law. Do not assume it will continue beyond tax year 2028 unless Congress officially extends it. If you value retirement information that separates genuine assistance from exaggerated promises, subscribe now. That is exactly what we verify on this channel. Number 3 may produce the largest immediate monthly difference for some lower-income Medicare beneficiaries. The standard Medicare Part B premium in 2026 is $202.90 per month. For many beneficiaries, that amount is deducted from Social Security before the remaining benefit reaches their bank account. Some people with limited income and resources may qualify for a Medicare Savings Program administered by their state. There are 3 programs most retirees should understand. The first is the Qualified Medicare Beneficiary Program, commonly called QMB. QMB offers the broadest assistance. It may pay the Medicare Part B premium, a Part A premium if the beneficiary does not receive premium-free Part A, and Medicare-covered deductibles, coinsurance, and co-payments. Medicare providers generally are not permitted to bill a QMB participant for Medicare-covered cost sharing, although a small Medicaid copayment may sometimes apply. For 2026, the listed federal QMB monthly income limit is $1,350 for an individual and $1,824 for a married couple. The federal resource limit is $9,950 for an individual and $14,910 for a couple. The second program is the Specified Low-Income Medicare Beneficiary Program, or SLMB. SLMB helps pay the Medicare Part B premium. Its listed 2026 federal monthly income limit is $1,616 for an individual and $2,184 for a married couple. The third is the Qualifying Individual Program, known as QI. QI also helps pay the Part B premium. Its listed 2026 federal monthly income limit is $1,816 for an individual and $2,455 for a married couple. QI participants generally must reapply every year. States approve QI applications on a first-come, first-served basis, with priority normally given to people who received QI benefits during the previous year. These federal figures are only a starting point. Limits are slightly higher in Alaska and Hawaii. Some other states allow applicants to qualify with income or resources above the federal figures. States may also exclude certain income or resources when calculating eligibility. That means you should not reject yourself simply because your income appears slightly higher than a number shown in a video. Let the state make the official decision. Be careful with broad claims about household size as well. There is no single nationwide rule stating that every adult child or grandchild living with a retiree automatically increases the Medicare Savings Program income limit. States can use different counting rules. Ask the state Medicaid agency how it counts spouses, household members, income, and resources in your specific case. Another major advantage is connected to prescription drug coverage. A person receiving help with the Part B premium through a Medicare Savings Program generally qualifies automatically for extra help with Medicare Part D costs. Under the standard 2026 extra help terms, participating beneficiaries may pay up to $5.10 for a covered generic drug and up to $12.65 for a covered brand name drug at participating pharmacies. Once total drug costs reach the applicable 2026 level, covered prescription costs may fall to zero for the remainder of the year. To apply, contact the Medicaid agency in your state and ask for a Medicare Savings Program application. You may also call 1-800-MEDICARE, which is 1-800-633-4227, and ask for help locating the correct state office. Use these words. I would like to apply for a Medicare Savings Program and find out whether my state can help pay my Medicare Part B premium or other Medicare costs. Applying does not guarantee approval, but assuming you do not qualify guarantees that your state will never evaluate your application. Number 4 depends almost entirely on where you live. It is property tax relief for older homeowners. There is no universal federal senior property tax exemption. There is no nationwide age requirement, income limit, or filing deadline. Property taxes and property tax relief are controlled mainly by state and local rules. Depending on the location, assistance may take the form of an exemption, credit, assessment limit, tax ceiling, freeze, rebate, circuit breaker refund, or payment deferral. Those terms are not interchangeable. An exemption may remove part of the home's assessed value before the tax is calculated. An assessment limit or freeze may restrict how quickly the taxable value or certain parts of the bill can increase. A credit or refund may provide relief based on household income. A deferral may postpone the payment but may not eliminate it. Pay especially close attention to the word deferral. A deferred property tax may become a lien against the home. Interest may accumulate. The balance may become payable after the property is sold or transferred, or after the homeowner dies. A deferral may still be useful for someone who needs immediate cash flow relief, but it is not the same as having the property tax forgiven. Take out your latest property tax notice and identify the county assessor, property appraiser, tax commissioner, or other local office listed on the document. Then ask, what property tax exemptions, credits, assessment limits, freezes, refunds, or deferrals are available based on my age, income, disability status, veteran status, surviving spouse status, and use of this property as my primary residence? Follow that with 4 more questions. Do I need to apply every year? What is the exact deadline? Can any benefit be applied retroactively? And if this is a deferral, will interest accumulate, or will a lien be placed against my home? Do not use a deadline or income limit taken from another state, county, or city. And do not stop paying your property tax bill merely because you submitted an application. Wait until the responsible local office confirms your approval and explains exactly how the relief will appear. Number 5 is the Medicare Income-Related Monthly Adjustment Amount, better known as IRMAA. IRMAA can increase both Medicare Part B and Medicare Part D costs for higher income beneficiaries. In 2026, the standard Part B premium is $202.90. IRMAA generally begins when modified adjusted gross income is above $109,000 for a single filer, head of household or qualifying surviving spouse, or above $218,000 for a married couple filing jointly. Special rules apply to certain married people who file separately. Social Security generally determines 2026 IRMAA using income information from the federal tax return filed for tax year 2024. That creates a problem when the older return no longer reflects the beneficiary's current financial situation. Someone may have retired after 2024. A spouse may have died. Work hours may have been reduced. A pension may have ended. Or another qualifying life-changing event may have caused household income to fall significantly. In those situations, Social Security may be able to use more recent income information. Form SSA 44 lists 8 categories of life-changing events: marriage, divorce, or annulment, death of a spouse, stopping work, reducing work hours, certain involuntary losses of income-producing property, loss or reduction of pension income, and certain employer settlement payments connected with closure, bankruptcy, or reorganization. There is an important correction to many online videos. Selling a home or taking a large traditional IRA withdrawal may increase your modified adjusted gross income and cause IRMAA. But a home sale or IRA withdrawal is not automatically a qualifying life-changing event under Form SSA 44. A one-time income spike may explain why IRMAA appeared. It does not by itself guarantee that Social Security will reduce the surcharge. If you received an IRMAA notice and then experienced one of the listed life-changing events that reduced your household income, review Form SSA 44. Supporting evidence may include a retirement letter, final pay statement, death certificate, pension notice, tax return, or another document connected with the event and your expected income. Call Social Security at 1-800-77-21213 and say, I am paying IRMAA, and my household income decreased after a life-changing event. I would like to find out whether Social Security can make a new decision using Form SSA 44. If Social Security received incorrect information from the IRS, or you filed an amended tax return, explain that separately. Correcting inaccurate tax information and requesting reconsideration after a life-changing event may require different procedures. Now, which of these 5 areas should you investigate first? Do not begin by asking which 5 bills disappeared. Begin with the documents you already have. Check your Social Security payment record for federal tax withholding. Check your most recent federal tax return for Schedule 1A and the enhanced senior deduction. Check your Medicare statement for the $202.90 standard Part B premium or an additional IRMAA charge. Compare your income and resources with your state's Medicare Savings Program rules. And check your property tax notice for the local office responsible for exemptions and relief applications. Here's the complete takeaway. Social Security withholding may be changed, but stopping withholding does not eliminate tax. The enhanced senior deduction is real, but it is not a direct $6,000 payment. Medicare Savings Programs can provide substantial assistance, but eligibility is decided under state-administered rules. Property tax relief may be valuable, but qualifications, deadlines, and consequences are local. An IRMAA can sometimes be reduced, but a lower income or one-time income spike does not automatically qualify someone for relief. Before stopping a payment, verify what the charge is. Before assuming you do not qualify, contact the agency responsible for the program. And before following a viral claim, identify the official form, eligibility rule, government office, and deadline. Which of these 5 areas will you check first? Share only the general category in the comments. Never post your Social Security number, Medicare number, tax return information, medical information, bank details, or exact private financial figures. Subscribe for clear retirement, Social Security, Medicare, and tax updates without misleading promises. And share this video with someone who may be paying more than necessary, not because 5 bills magically disappeared, but because legitimate relief often begins only after the retiree asks the right question. This content is for general educational and informational purposes. It is not individualized financial, tax, legal, Medicare, Social Security, or healthcare advice. Confirm your personal circumstances with the responsible government agency or an appropriately qualified professional before changing withholding, filing a tax return, stopping a payment, applying for assistance, or challenging a Medicare premium.